Welcome back, my dear students. Welcome back, everyone. This is your teacher, Dr. Osama Kashwan. This is a new lecture in the depreciation. How to make, we call it accounting for depreciation. How we will do the depreciation accounting and how we can work on this. What the meaning of depreciation? Depreciation. Depreciation is the low, gradually descendant value of an asset. Any assets, ASSET, which a company own or possess, this asset, if you buy a car today, the price of this car today is not like the price of this car tomorrow. Logically, the price will go down. Price will go down. This, we call it depreciation. Depreciation. So how we will account for the depreciation, and the first way to account for the depreciation, we call it straight line method. Straight line method. Assume a building is purchased by a company on January 1 for cash of $600,000, for a cash of $600,000. Based on the experience, with this I'm giving just an example now. Based on the experience with similar properties, officials believe that the structure will be worth only $30,000 at the end of the expected 5 years life. So this asset, guys, is having 5 years of life expectancy. Means but after 5 years, it will be residual, it will be scrap. After 5 years, it will be scrap. Calculate the annual depreciation. Look at this. Calculate the annual depreciation. And this is the point which we want to know. Using straight line method, the most familiar way to do the annual depreciation is the straight line method. So I just now highlighted. Calculate the annual depreciation using straight line method. Record the transaction in the accounting journal. Record the transaction in the accounting journal. Cool, that's right. So the point is that I will calculate the annual depreciation using straight line method. Record the transaction in the accounting journal. So here, how we will do the depreciation, the annual depreciation. Actually, the annual depreciation we will get it like this way: cost minus estimated residual value. Okay, that is divided by expected useful life. So that's all will give me the annual depreciation. Let me just take it somewhere else. I will just copy and paste. And to be clear for everyone here, because it's not, this makes extra sense like this way. Okay, so this I will take the annual depreciation side, and I would say equal cost, here we go, minus estimated life value divided by the exit. Here now I can say it looks like a good equilibrium. Here we go. Here we go. So the annual depreciation will equal the costs. The cost was 60,000 here. In this example, the cost was 60,000 minus 30,000, which is the residual value. The residual value here is 30,000 at the end, divided by expected useful life, which is 5 years. Like we see here exactly in front of us. So 600,000 minus 30,000 divided by 5 years, which will give me depreciation expenses. That will be the annual depreciation for every year. It will be the annual depreciation for the first year, for every year. Actually, the first year 114, second year 114, third year 114, and fourth year and fifth year. So in the 5 years, each year 114 times 5 will give me this amount, 570. Again, I would say, the cost of the asset. The cost of the asset is 600,000 minus what? Minus the residual value. Residual value is 30,000. Divided by numbers of years. How many years this asset is live? 5 years. So divided by years, 5 years, that will give me depreciation expenses for each year, which is 114,000. For each year apart will be 114,000. So what? So now let us see how we will calculate. Again, I will say again once more, the cost I bought this car or vehicle or whatever or machine was $600,000, 600,000, and the residual was 30,000. The residual for 30,000, and numbers of years expected 5 years. So I will say 600 minus 30,000 divided by 5 years. That will give me the annual depreciation 114,000 per year. This will be the annual depreciation 114,000 per year. Perfect. Perfect. How will I do the depreciation? First year, I bought this building for 600,000. So I would say from building to cash. We said before that any expenses I write it with its name. So if I say as example, the building, I bought a building. From building, I bought furniture. From furniture to cash. I bought whatever I get. So I name the name of the expenses into cash. From building to cash. Okay, here we go. Okay, now the second thing is how I will account for the depreciation. What is the depreciation account? Cool, that's fine. First thing is from depreciation expenses into accumulated depreciation. From depreciation expenses into accumulated depreciation. That is the buildings. How much it is? 114,000. Why? This is the annual depreciation which we calculated, 114,000. So it will be from the depreciation into the accumulated depreciation. What is the account of the accumulated depreciation? In the 5 years, at the end of the 5 years, I will have the total of the depreciation, which was 570,000. This amount, 570,000. So at the end of the 5 years, each year, your asset is reduced 114,000. So this is the first, second, third, fourth, fifth year. In the 5 years, your asset will be reduced 570,000 in the 5 years. So this is the meaning of the accumulated depreciation. So the journal entry for my own work here will be, the journal entry will be from depreciation expenses to accumulated depreciation. Only from depreciation expenses into accumulated depreciation. And this is all my work I will do. So in this example, I will tell you, so in this type of examples, I will tell you, set the journal entries. First, calculate first I will ask you calculate the depreciation. Then second, I will tell you set the journal entry for the transaction. Set the journal entry for the transaction. So first, calculate the depreciation. That's it. From the cost minus estimated or the residual value divided by numbers of years expected life. So again, that was 600,000. I bought this building with 600,000, and the price of this building after 5 years will be 30,000, and it will live for 5 years. So 600 minus 30 divided by 5. 600 minus 30, it will give me 570,000. I will divide it by 5. Then the annual depreciation is 114,300. 114,000 per year. Then I will do the transactions. First, I bought the building with 600, so I would say from building 600 into cash 600. Then after that, 1, 2, 3, 4, 5. 5 years. Each year, I will say from depreciation expenses into accumulated depreciation with the amount of this 114,000. Now, I will give you an example. You will go for an exercise for this question. You will go for an exercise, please. We'll say the same thing here. And Control and C. And let me put for you the example here. Exercise. We'll change the numbers only. Control and V. Here we go. Assume that a building, we will say that a vehicle, V-E-I-C-H-L-E, a vehicle, is purchased by the company on January 3. That's fine. Or let's say it's January 1. Year 1, cash off. Let us say this is 100,000. Based on the experience of the similar property vehicles, V-E-I-C-H-L-E-S, vehicles, official believes that the structure will be worth of 20,000. I will make it 20 at the end of the expected 5 years. Also, let us leave it here. 120, make it 8 years. 8 years. E-I-G-H-T. Life of calculate the annual depreciation. Calculate the annual depreciation. This is the first thing we need you to do. And set the journal. And the journal. For using what? Look at this, straight line method. You will use the straight line method. You will use the straight line method. Okay, guys, I'll give you around 5 minutes to solve this question before we move into the second part. I'll give you 5 minutes to solve this question before we move into the second part. Let me remind me quickly how we solve the problem. Here it is. And here are the journal entries from depreciation expenses into accumulated depreciation with the amount of annual depreciation. This is a transaction of the straight line method. Here we go. And this is your exercise which you are working. This is an exercise. This is an exercise for you guys. So please work on it right now. Thank you so much. Cool, that's very nice. Now let's go for the account for this. Let's go for the solution for this example. So I would say the annual depreciation, Control and C. I will go for the solution now. annual depreciation will equal, the cost is 100,000. I have to write the equilibrium back, and the equilibrium, I wrote it here. If you see, I wrote the equilibrium here. It's here. So I will take it back like this, Control and C. And I will put the relationship. The annual depreciation will equal cost minus estimated residual value divided by number of years life. So here that will equals 100,000. Here is the 100,000. Control and C. That will equal 100,000. Control and V minus the residual value is 20,000. The residual value is 20,000. Control and C. This is the residual value. Then I will put this into between brackets like this way. In between brackets like this way. Then this is divided by number of years. The number of years here, we said 8 years. 8 years. Let me write it 8 so that no one, okay. So divided by 8, that will equals 100,000 minus 20, that's 80. When you do this, it's 80 divided by 8, that will give me 10,000 per year. 10,000 what? Dollars. What is the meaning of this? It means the assets value reduced with the amount, this amount was $10,000 per year. Again, this 10,000 means that the amount of the asset is reduced annually with 10,000 a year. Annually with 10,000. Every year, this asset is losing of its value 10,000. Like you bring a car, the first year is not like the second year, the value of it is reduced. So this is the deduction which we will cut from the price of the car every year. Okay, this is the first point. Second point now, to do our own calculation. We do like this in the start itself. We will say the first transaction, let us go and do our own table. Here we go for the table. We set 4, and we go down like this way. Then on the first year, as example, on Jan 1, let's say Jan 1, the first year we bought it from vehicle into cash, VEICHLE into cash, and the amount was the debit here is we bought it for 100,000. Here we take the 100,000, Control and C. Here we bought the 100,000, Control and V, and here we get like this way from vehicle to cash, and the transaction is buying a vehicle. Then every year we have depreciation of 10,000 every year for 8 years. Control and C. Then here we will say from depreciation expenses to accumulated depreciation. So depreciation is DEP, expenses EXP, accumulated ACC DEP, and you can write it the whole, or you can write it only 10,000. Then here 10,000. Now the point is that we will repeat this one every Jan of every year. So Jan of every, let's say this is here as example, it was on January 1, 2010. So that's 2010. Exactly like what we did here. Look at this here. When we did the transactions here on 111 on the first year of every the last month of every, or the last day of every year. So on December 1, 2010, on December 1, 2010, this is the first one. Then this is annually depreciation. How many times I will repeat this? I will repeat it 10 times. I will repeat it 10 times. Control and C. Then I will go to the next, Control and V. But I will change here, it will be 11. The third, Control and V. This will be 12. This after that, Control and V. This will be 13th. Then after that, Control and V. This will be 14th. All the way down. I have to count 10 depreciations. 1, 2, 3, 4, 5. Here, December 1, Control and V. 15. Then it's okay. Even if I did one more, then I remove it. But I have to count them how many times they are. How many times? Because we have 10 years. 1, 2, 3, 4, 5, 6, 7. Still we have 3 more. Control and V. This is December 17. Then we'll go to the next one. Control and V, December 18. So let's count now how many? 1, 2, 3, 4, 5, 3, 4, 5, 6, 7, 8, 9, 10. Here we got it. Because we started on 10 and the estimated life is 18. So we have here 10 right now, the annual depreciation of each year. So you calculate it like 80. In the exam, I'll tell you, do the calculations for the first 1 year or for the first 2 years or whatever. So you will be ready for that calculations. Again, today we talk about the straight line methods. We talk about the straight line methods and how to calculate the straight line methods. Again, the straight line method will say the cost which you bought the value of the asset with minus the residual value at the end of the useful life divided by the useful life expected. So 100,000, I bought it with 100,000, and actually at the end it was with 20,000 only at the scrap value divided by the number of years, which was 8 years here. So this will give me annual depreciation 10,000. We said what the meaning of this 10,000? 10,000 means that every year this asset is reduced with the value of $10,000. Every year is reduced with the assets of $10,000. And then we do the accounting for the depreciation. We say from each depreciation expenses into accumulated depreciation for every year from the 10 years, those 10 years. Shall leave you now in peace. Take care of yourself and go to the next video. Stay safe, everyone. Have a wonderful time. Bye-bye.